All right, so today I wanted to talk about a company that I've brought up before, but I've never actually dove deeper into, and that is AGM, Federal Agriculture Mortgage Corp or Corporation. So again, they're in the financial services industry. Obviously, they are lending money, but let's get into a little bit deeper and just to see the description. Stockholder-owned, federally chartered corporation. The company is headquartered in Washington, D.C., blah, 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 blah. So again, it has two lines of businesses: agriculture finance and rural infrastructure finance. It includes farming and ranching, corporate agri-finance, rural utilities, and renewable energy. So that's kind of the areas that it goes into. And again, corporate ag finance segment includes loans in AgVantage securities for farming operations. Agribusinesses focus on food and fiber processing and other supply chain production. The renewable energy segment includes loans to rural electric and solar with wind projects. Its rural utilities segment includes loans to rural electric generation and transmission cooperatives, distribution cooperatives, and telecommunications providers. So the first thing that I noticed here is that they're actually fairly diversified, right? I mean, they're in the agriculture side, they're in the renewable side, and even within the agriculture side, they're fairly diversified into a bunch of different areas. So again, depending on how you look at it, I think most people would probably say that's a good thing, right? Analysts are bullish. That's the first thing I noticed, very bullish. And another thing you'll notice here is this company is basically at its 52-week high, about 153. It's currently at about 148. That range is 90 to 153. So again, very close to that 52-week high. But if we get in, as we get into it a little bit deeper here, I think that if anything, this company probably is still a little bit below fair value, and I think that's a testament to the average analyst rating being 178. That might be a little bit rich, but I think it's definitely worth a little bit more than it is right now. Free cash flow yield of 38%, earnings yield of 12%, right? So this company is just a complete cash cow, like just very, very profitable. Again, let's get into the insights here just to kind of get into that. The dividend I'll get into after. Again, it's growing very, very nicely, almost perfect growth, right? Revenue way up, gross profit way up, operating income way up, net income way up, operating cash flow way up, everything's way up. Profitability, again, also very, very nice. 35% gross margin, 25% operating margin. Just very good. Cash conversion, insanely good. So again, if we get into the valuation here, based on free cash flow, it is above that by a decent amount. But if you look at PE, if you look at price of sales, it's below. So I think that points to the fact, or it's debatable, obviously, but in my opinion, I think it's still a little bit below fair value, right? And that's once we see that PE. When it comes to financial companies, I don't think price to free cash flow is the best thing to go off of, and that's for reasons that would take too long to go into. But that's basically the insights here. Let's get into the dividend, right? Because honestly, the main reason, in my opinion, you're buying this is the dividend, right? So again, current yield is about 3%, just a hair under 3%. But the big thing to go off here is they're growing it at 13.6% per year, right? That means that you're doubling it, every 5 years, roughly, right? Roughly. So again, 5 years from now, 6%. 5 years after that, or 10 years from now, 12%, right? So again, you're going to have a 12% yield. Let's just say roughly, maybe be conservative and say 10%, 11% in 10 years for a company that's still going to be growing. In my mind, it's just a no-brainer. This is one of those companies that I think there definitely is some risk to it. Obviously, there's risk to every company, but I mean, if you go back, let's go back 10 years just for sake of curiosity here, you would have almost a 15% yield on cost, right? Almost a 15% yield on cost. So again, why would you not want that, right? So if we compare it to the S&P, this is a company that's easily outperforming the S&P over the last 10 years, right? 380% versus 218, right? Just dominating the S&P for like a basic financial services company, right? That's crazy, right? If we go 5 years, it's still outperforming by actually a decent amount, 84 versus 67, right? So again, a company that consistently outperforms the market, right? Why would you not want that, right? Payout ratio, 24%, right? So again, I would be shocked if they didn't grow this dividend by at least 10%. I don't if they've done it over the last 10 years. I don't know why they wouldn't do it over the next 10 years, right? Obviously, again, dividends, there's nothing legally requiring them to pay a dividend. You can cut the dividend at any point. But a company that has a track record of paying it for over a decade, that has a payout ratio of 24%, very unlikely that dividend is not going to continue to go up over time, right? So this is a company that I like. It's not my cream of the crop companies. I have about 8 to 10 that are just I can't get enough of. This one's just outside that. This one would be in that 10 to 20 range. Hence why it's in my top 20 stocks, why it's in my mock $1 million portfolio. These are the kinds of companies that I like. I kind of differ from a lot of people, right? In that I love companies that are growing, that are going to keep growing, that have a dividend with a nice growth rate, because that's what you want, right? I mean, the traditional way of investing is, you put your money in, disproportionately higher number in stocks, and over time you go back to bonds, and it's like, okay, well, if I have a 20% yield on my portfolio when I retire, why would I go to bonds when I'm returning 20% a year, regardless of what the market does? To me, that makes no sense, right? But I don't think that most people think of it that way. And again, obviously, there's more to it than that. Again, the market could go down 30-40%. I understand that. But if you position yourself properly and you start early enough, in my mind, it makes no sense to do the traditional form, right? And that's why I love these companies, right? Because you're going to have these crazy, crazy high yields on cost down the road. I mean, let's go back like 20 years for this company. Let's see what you would have. It would be roughly a 21% yield on cost, right? So again, if you have a 21% yield on cost, why would you sell that? Why would you sell that, right? Why would you sell that? Like, it doesn't matter basically what happened. Like, the company could, like, the share price could do nothing for all you care. You're going to return 21% a year. Like, that's insane. So again, I'm not saying you're going to get a guaranteed return or anything like that. Always, like I said, there's always more to it. There's always risk that's unforeseen, yada, 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 right? Everyone knows that spiel, right? But in my mind, it just makes no sense to not go that route, right? And a lot of people get confused that they chase the high dividends, like some of these companies that have your 10, 12% yields, but the share price is doing nothing. Or if anything, a lot of these, like the BDCs and mortgage REITs and companies like that, like the share price is going down over time. Yeah, it's got a 12% yield, but if the share price is going down 2-3% a year, you're not getting further ahead, right? So in my mind, the best of both worlds is to buy companies like this that are growing, that are going to continue to grow, and are going to grow that dividend by 13% a year, right? Again, it's just a matter of deferring gratification and being patient, right? I mean, Warren Buffett is famous for saying that the stock market is the thing that transfers wealth from the patient, or from the impatient to the patient, right? From the people that can't defer gratification to the people that can defer gratification. And I mean, those are the people that are most successful at anything in life, right? I mean, if you take the people that are the best at deferring gratification, they're going to be the people that are at the top of anything, right? Business, fitness, like you name it. Investing for sure, right? That's the best example of it. But the people that are the best at deferring gratification are going to be the top of every single field, right? So anyway, just wanted to leave it there. If you like the video, again, like, subscribe, comment. I always like hearing feedback and critiques or whatever. So hit that like and subscribe if you haven't already, and stay tuned for more.